Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. It's a record-breaking run on Wall Street. The S&P 500 jumping to a new high as investors bet big ahead of tech earnings, and it was a big tech leading the way. The Nasdaq was up nearly 1%. Shares of United Health, though, missing that rally. The stock dragging the Dow down after plunging nearly 20% on the day. The company hit as the government unexpectedly announced plans to keep Medicare payment rates virtually unchanged. We have Anna's reaction to that. Plus, electricity costs have soared for Americans, and while AI has been getting a lot of the blame lately, there are more factors at play. What you need to know, that's straight ahead. Well, mergers and acquisitions are set to have another bumper year in 2026. That's according to a new report by Bain & Company. It found global M&A activity in 2025 valued at $4.9 trillion. One of the authors of that report, Suzanne Kumar, is with me. She is Bain & Company's Executive Vice President of M&A and Divestitures Practice. Suzanne, it is great to see you. So let's just start high level here, Suzanne. So you talk about the great M&A rebound in 2025. You say broad-based, spanning industries and regions. Maybe start there. What is driving that, Suzanne, and is that durable? What do you see for 2026?
Right. I mean, this rebound is a great rebound. It was up 40%. That's 4.9 number is the second highest year on record. And it was sparked by an easing of headwinds, right? Mm-hmm. So the cost of capital is moderating, valuations were bringing sellers and buyers closer together, regulatory was more favorable. But really what fueled this market is a need for strategic reinvention. Companies
What does that mean, Suzanne, strategic reinvention?
Right. So, we're in a fast-changing world. Mm-hmm. Technology disruption, post-globalization. Profit pools are getting disrupted by everything from streaming to the latest innovation. And in that world, companies need a strategic response. M&A brings you faster to new capabilities, faster to new kinds of customers, optionality when you're looking to enter or exit a market. This is what's really behind the great rebound.
So the great rebound, to the extent the strength continues this year, Suzanne, where would you expect to see the activity? Are there certain sectors you would call out?
I expect the rebound in this wave of M&A to continue to be broad-based in nature for sure. A few that I would call out, we've seen banking really do come back in M&A in an interesting way. So whereas before a lot of the deals we saw were consolidation, scale for scale's sake, which makes sense in the banking space. Now we're seeing banks do deals that mix scope elements, right? Revenue, growth, bringing in new capabilities like payments. And the deals that have both scale and scope elements are bringing more value to those banks. So that's one to call out.
What about the risks you see in 2026 for the rebound? Is it rates? Is it regulation? What will be on your radar?
Well, certainly the general macro environment always has an impact. One constraint that we're seeing right now is competing demands for capital. So even amid this great rebound, one of the paradoxes is that capital allocation to M&A is at an all-time low, 30-year low. And that reflects some real competing demands that the companies are struggling with. Boards and CEOs and CFOs have to think about not only share buybacks and dividends, but also reinvesting in the business for technology modernization, automation, supply chain resiliency. So for M&A, every deal needs to deliver concrete value, really earn its place in the portfolio of investment.
What about AI, Suzanne? Do you see that driving M&A in just tech, or no, you see it spilling over in other industries?
It's still early days for non-tech players to be investing in AI, but they're thinking about it for sure. In diligence, most companies are now asking what's the impact of AI going to be on this target's business model. And as a result, 1 in 5 are increasing their valuation, getting more conviction, and 1 in 4 actually walking away from deals. So they're thinking about it with almost every deal that's being made.
And when they're making an AI play, Suzanne, do you have line of sight whether it's commonly for AI tech? Is it AI talent? Is it both? What do you see there?
Yeah, all of the above. Nearly half of tech deals last year had an AI component. The number of AI native companies that are trading is still relatively small. Many more deals have an AI element related to it.
You also call out a trend here in scope deals, Suzanne. So one, What is a scope deal? Explain that to us, and how should investors interpret that trend?
Sure. So scope deal making was an all-time high. These are the deals that are for revenue growth or capability building. They might bring you into a new customer segment or a new geography or another part of the market that you're not participating in today. These kind of deals are really important to long-term growth. They set you or set a company on a new growth trajectory. And what we notice is that the companies that are creating the most value for M&A do a really healthy mix of both deals for scale and efficiency and scope for growth.
Finally, the antitrust backdrop, I just want to end there, Suzanne. New regime, obviously, FTC, it's Andrew Ferguson. What kind of impact, if at all, are you seeing from that?
I think on balance, we're seeing a positive impact from more certainty in the process. So, for example, a willingness to have a discussion about remedies gives deal makers more flexibility to get a deal done.
Suzanne, great to see you, especially on set. Thank you.
Yes, thank you.
Well, President Trump visiting with voters in Iowa ahead of his speech on the economy, and Trump weighed in on recent moves in the dollar, which has been under pressure, hitting its lowest level in 4 years.
President, are you comfortable, Mr. President, with the current value of the dollar? Do you think it's declined too much?
No, I think it's great. I mean, the value of the dollar, look at the business we're doing. No, dollar's doing great. You know, it's very interesting. If you look at China and Japan, I used to fight like hell with them because they always wanted to devalue their yen. You know that? The yen and the yuan. And they'd always want to devalue it. They devalue. And I said, not fair that you devalue because it's hard to compete when they devalue. But they always fought, no, our dollar's very good.
The Trump administration's roller coaster of international relations, trade, and fiscal policy since the start of the second term weighing on investors. Stick around, much more As for a Trend that's still to come. Shares of United Healthcare sinking, pulling the Dow lower with it. The health insurance giant's upbeat forecast overshadowed by news of the Trump administration proposing to raise Medicare payment rates by an average of just 0.09% next year, well below what companies and investors were expecting. Jared Holz, Mizuho America's healthcare equity strategist, joined Julie Hyman on Market Catalyst this morning to discuss United Health's results and the impact of this rate change on its business.
I think it's multifaceted. I mean, some of it is just stemming from prior year disappointments, and so this just adds another layer to that. I think from a sentiment standpoint, that's really important to consider. It's not like this was the first piece of bad news we've gotten for the industry or for the stock. When you look at the quarter, it was actually not so bad. The MLR was better than expected. There were some bright spots to kind of talk about. But then when you fast forward to 2026, which is more important, and then 2027, it just doesn't seem like there's that much upside to numbers. And that was really what a lot of investors were going on into earnings, was that you were going to see some shift in earnings higher and maybe get a conservative guidance with room for upside. And I just think that's sort of off the table near term.
And it seems as though Optum, which had been one of the sort of profit generation engines of the company, and it's sort of a subsidiary of UNH that provides pharmacy benefit services, but other types of services too. It seems like that is now shrinking. Is that also, I guess that's not necessarily unexpected, but is that something that also is going to mean things are going to be slower?
I think both sides of the business, big picture, are shrinking a bit. I think this is sort of United's approach in terms of, getting the overall business to better align with the cost structure. It's been very, very difficult, I think, for so many companies in managed care to predict the future. We've seen some really big numbers misses out of all of them pretty much over the past couple of years. And so it's not that distinct to see shrinking of the business. I think the profitability is okay. But again, when you talk about what needs to happen for the stocks to start working, I think we need to start seeing some real earnings leverage coming out of both pieces of the business, and that's just not happening.
Jared, taking a step back, right? When you talked about MLR, for folks who don't know, that's the medical loss ratio. It's the percentage of premiums that United Healthcare collects that it's paying out to pay for healthcare, and that has been a challenge for it and other insurers. Is there anything that these guys can do, something that would be good perhaps for all of us, to get the cost of healthcare down in a way that would help their margins? Are they working on that at all?
I think they're trying to. I mean, part of the 2026 number is a little bit more hemorrhaging of the patient population that's higher risk. I think the company is trying to downsize in certain areas of the market, which have been either problematic, difficult to predict, all of the above. And so I think that's already starting to happen. The MLR has been very hit or miss. There's been a difficulty or a complexity with respect to predicting patient movement and activity. Not just United, I would say for most of the companies in this sector over the past few years. Some of that stemming from COVID, which put a lot more patients into the system following the pandemic. There's some typical demographic shifts, but this has been the toughest piece, I think, of investing in managed care, is that the companies haven't really had visibility. And if they don't, it's tough to think that investors do.
But if they're not covering the sickest people, I mean, maybe it'll be lower cost for them, but ultimately won't it be higher cost for the system?
It's possible. I mean, a lot of what investors are talking today about is, can United, can they kind of like shrink the cost structure? What can they better do to align revenues and expenses? And part of that is cutting benefits. So I think a lot of the patients on United plans or otherwise are going to see, because of what's going on in the industry, they're going to be paying the same but getting less. I think that maybe from a societal standpoint, the most problematic piece of all of this is that you're going to see patients that pay X but get way less than they used to in the past.
That does seem problematic. Jared, and then there is the other big story that we are watching, which is that the Medicare Advantage reimbursement rates are now expected to be less than expected for 2027. How important is that for you? I mean, UNH is a huge company, so I don't know how important on a relative basis Medicare Advantage is. Can you help us understand that, and then the effect it's going to have throughout the industry?
Yeah, it's really important for UNH, for Humana, for CVS, and for a couple others as far as what it does to numbers. I think a lot of the street models sort of implied or assumed that Medicare Advantage rates would go up next year by something around 5%, give or take. And so to see CMS come out and say that they were going to reimburse that category on a flat year over year, it just pressures earnings even more, right? Because the spending at the companies, probably the way that the companies are setting up for 2027, I believe probably assumes some sort of uplift in terms of reimbursement. Now that looks to be flat versus 5%, you're 15 to 25% of the business for several of the companies in this category is going to be impacted. Again, I think the number, it's tough to tell on a true numbers basis for a little while, because these patient populations on a per company basis seem to change a decent amount, but it's going to have a big impact. I think that's why for the next couple of years, even though United, I think, is being fairly assertive in saying that they're going to grow earnings, I think it's going to have to come from other areas of the business, including cost cutting, to get them there.
Jared, in having this discussion with you, whether it's about Medicare Advantage or about the fundamental business, I mean, I think we're all pretty aware that healthcare, the health insurance system in this country is pretty broken. We've had the discussion in Washington before, but it seems to be coming to a head in a different way. But does it feel like anything is going to change here?
I don't think so. Not over the near term. I mean, we talk about the brokenness of the system constantly. It just doesn't seem like there's an outcome that's going to happen anytime soon that allows all of the verticals within healthcare to act well simultaneously. So I think right now what we're seeing is a little bit of a thawing out in pharmaceuticals, arguably, with the drug pricing conversations having been had and some regulations going into place this year. And I think some of the discussion or discourse coming from DC is now squarely on managed care, providers, other segments of the market. I truly don't think there's anyone in the administration that's willing to, or at least has come out publicly and sort of blueprinted a plan that is going to, tackle the issue, recreate the healthcare system, what have you. So I think this is just an ongoing conversation we have.
Is there any reason for investors to look at these stocks?
I don't know. I think eventually, when you get these sort of visceral reactions to, single stocks and multiple stocks within a category, you let it breathe for a little while and then come back to it. It's really going to come down to what is the path for either a United or others in the peer group to sustainably grow earnings and show visibility. Now, I don't think we have that today. I don't think we're going to get that tomorrow. But I think one thing that's interesting is that the CMS Medicare Advantage final ruling will come out sometime in April. And so maybe there's a trade into April where you can go long this group for a little while in, aspirationally thinking that Medicare rates are going to be a little bit better.
Stick around. Much more Ask You for a Trend still to come. Rising energy costs are powering up utility bills, and it's not just the Arctic blast. Yahoo Finance's Claire Boston joined now with a closer look. Claire.
Hi, Josh. So when we're looking at utility costs, we have seen them absolutely spike, especially in the past year. Electricity is up 6.7%. We have fuel oil up 7.4%. Utility gas is up over 10%. And then if you zoom back a little further, this really started in 2020. We have seen electricity costs rise 40% in the past 5 to 6 years. And so if you've got sticker shock right now, you're not alone.
What about data center demand specifically as a factor?
Right, so that is the million-dollar question. I think people are very concerned about what data centers are doing to their bills. And it is absolutely true that data centers are playing a big role in what we are seeing go on. They are pretty big users of electricity, and their demand is raising costs for everyone because of the way that utilities do their billing. They kind of spread those extra demand costs around. And this is something that may change in the future because we are in this weird moment where we have one sector that really is stressing the grid, and it's probably not fair for residential consumers to be paying for that, but we're in a moment where that's still being figured out.
What about whenever we have this conversation, aging infrastructure always comes out, right, as a theme, as a topic. How does that play into all this?
Definitely. Infrastructure is another big factor. Our grid in the US just happens to be pretty old. A lot of the things like wires, like towers, transformers, all those things are sort of near the end of their natural life. And so they need to be replaced, and those costs will get passed on to consumers as well.
So when you looked into this, by the way, all the drivers, right, like playing into rising utility bills, Claire, was there one we would say, okay, that's the big one, that's the one to focus on?
Yeah, so when you think about the big drivers, we have data centers, we have infrastructure, we have climate change, which makes rebuilding more expensive. The biggest thing is going to ultimately be those infrastructure costs, because when data centers demand more, we need to upgrade our grid. When climate change causes a big wildfire, the grid also needs to be repaired. And it's getting more expensive to do that. Supply chain costs have really driven up prices recently. Tariffs also not helping here. Mm-hmm. Unfortunately, a lot of the people I talk to say that probably in the near term, these utility costs are only going to get more expensive as we make these upgrades.
Claire, great to see you. Appreciate it.
Thanks, Josh.
That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet.